Hey everybody, it's Pete. Good morning. It is a new episode of Stocks for Breakfast. Today we're going to talk about what has become a heated topic in the community inside the boot camp, which is profit-taking strategies and wanting to have this desire for somebody to tell them, tell me exactly where to get out. That's very challenging to do because you might have different goals, and that person has different goals, and that person has different goals. So to be telling somebody, this is exactly where you should get out, it puts you in the situation where somebody might feel like, well, I left money on the table or I didn't get the most out of the trade. I will tell you this, it is unique to each of us how much we want to earn, what we might consider to be a good trade. However, there are definitely scenarios, there's definitely profit targets that we should at least adhere to and be aware of, that these are the first places that we should start to look for profits. Now, that's a good thing that we're having this conversation because that means most of the conversations we're having are about profit taking, which is great, right? If the biggest problem we have right now is deciding where we're taking our profits, that's a pretty good situation to be in. But we're going to break this down a little bit further as we're going to discuss day trading profits versus swing trading profits. We're going to discuss profit targets and then what's known as a trailing stop loss and how to use the two of them for a situation where you're day trading and a situation where you are swing trading. So we're actually going to head over to the charts. We're going to head over to a software called FinViz. And again, I want to show you that I'm using the free version of FinViz, which is the basic version. There's no real-time charts. It's basically just a screener. But there's one little number in there that is crucially important to day traders, especially for the perfect target area. So we're going to head on over to the charts right now. Oh, by the way, if you like these videos, definitely click down and subscribe. That would mean the world to me. And if you want to trade with me in real time, click down and learn about the bootcamp in the description. You have a link down there to see how other traders are doing. So we're going to start out by looking at FinViz. Before we even head into the charts, finviz.com is the name of the website. And we're going to type in any stock. It doesn't matter. So I'm just going to type in Apple, just as an example. We're going to take a look at Apple, and we'll take a look at Penn. This way we have two different stocks and two different big dollar amounts. So it's just basically typing in Apple, and you can see that they have all this news and all that kind of stuff, and all that's great. But out of everything that's on here, as an active trader, we're looking at this number right here. ATR is what's known as average true range. And if actually I highlight over that, you can see that it's 14 period average true range. And that basically means that over the last 14 days, the average price action from the low to the high is $5.60 in Apple right now, which is obviously split adjusted. So we're going to write that down, $5.60. Then we're going to go over to a stock, let's say Penn, which has been very tradable lately. It actually had a pretty good day yesterday until the market sold off. Penn has an average true range of $4.15. Now think about that. Apple's $100, has an ATR 560. Penn is now, what is it, 60, something like that? Where's the price? Yeah, closed at 62.46. So it's $40 less and has a $1 less trading rate. So essentially what that's telling you is that Penn is a very active liquid, not liquid, a volatile stock relative to what it does. So on any day that it can move an average of $4, that's a pretty big move. And you can see yesterday, a $4 move represents 7%, 7.41% in one day. That's pretty big. Now, that was part of the gap and whatnot, but let's go over to Penn and take a look at the trading range. That's what we want to focus on right now. Because essentially what we're talking about right now is opportunity. We're balancing opportunity with risk. So in this case here, we're mostly talking about the plus side, the opportunity side. So on this particular day here, the low was 52.58 and the high was 59.10. So at that point, it was a $50-something stock that had a $7 trading range. So we just said that the average true range is $4.15 in this stock. One day was $7, almost 2 times what it normally does. That's the problem, a challenge, I should say, that most traders have is how do I manage my profits to squeeze the most out of a position while at the same time not giving back profits. So we can actually go to yesterday as an example. Yesterday we had the gap up, and the low was $60.93. So let's just say 61, and the high was 65.79. So that almost perfectly matched the average true range number. And this is a good example. So we're going to actually hop into the stock, and it doesn't matter what happened in the market after hours. We're basically talking, excuse me, not after hours, after at the end of the day. This is really more a discussion around, if a stock moves what it normally does, what should you do? So, and I want to make something clear, which is also a super good example here again. The average true range does not calculate the gap. Has nothing to do with the gap. The average true range is from the low to the high, from the low to the high. That's what the average true range represents. The gap does not matter. The gap is not calculated with the average true range. So going into the day, you know that Penn has an average true range of $4.15 from the low to the high. So this was the low at this point, which was, let's call it $61. And at this point, the stock traded up to 65 and change. So right here in the first 15 minutes of the day, the stock already went its average true range. So now you're saying to yourself, well, I love trading the stock. It gapped and it had a powerful move that moved the entire average of what it does. Now, here's the challenge that traders are having. Experienced traders are mostly concerned with, did I make as much as I could in that situation? Inexperienced traders, and I'm going to say this very respectfully, have this misconception that you're going to get the top and the bottom, you're going to squeeze every dime out of it, or when you get out of it and you book what might be termed a good profit, you moan or feel like you left money on the table. Moan is probably a strong word. You feel like you left money on the table. That's a very challenging thing, because I'm all for wanting to improve, but the market, especially day trading, that's the point that I'm making here. The market, especially day trading, has a lot of movement in both directions, but could ultimately end up at the same spot where you expected it to be at the end of the day. But the question is, and we saw this yesterday in Penn, in a stock that exploded, went to its average true range, and now what do? Do you start to trade it after the first 10 minutes, the stock actually got up to that level, and now you're like, well, the stock's done for the day? Maybe, maybe not. How is the overall market trading? And this is really where tape reading comes into the equation. The stock is at all-time highs, had good news, gapped up, kept going, but it traded what it normally did. So now you have to add the market into the equation. We're going to get to that in a second. But here's the thing. The average true range, regardless of a gap, regardless of the other stuff that's going on in the market, that has to be your first target. Now, that doesn't mean where you get out. It means that's your first target, because if a stock normally opens here, has a low here, and normally it goes up to here, you're not guessing. That's actually what the stock does on a day in and day out basis. Doesn't matter where your entry price was, although you have to think twice about where your entry price is compared to the average true range. Because you think about it, if the stock has gone 80% of what it normally does and you're looking to enter it, should you buy that? Well, what is your profit potential and how much do you have to risk? That's not as easy as that. Again, I keep using driving as an example. If it went 80% and the market's ripping, everything on your watch list is green, that's a situation where you're probably going to get more than the average true range. But if the market's traded like yesterday, the market trading lower, as a matter of fact, the market getting spanked, and this stock is actually trading at the highs, how much further would you expect than the average true range? Now, stock-specific ideas can absolutely follow through, but remember, we're trading for what happens most of the time. We need to know what we're definitely going to do, but what happens most of the time. So the unknown factor is what's going to happen next, right? So what I want to bring home here is the average true range should always be your first profit target. But then what do you do after that? Do you just get out? No, absolutely not. Absolutely not. What you need to do now is use what's known as a trailing stop loss from whatever that high is. Now, there's a couple of different ways to do it. Once it reaches that high or hits that average true range, you now need to say to yourself a couple of things. Do I want to manage this position based on how much profit I have in the trade? Do I want to manage this with the trailing stop that says, if this stock pulls back 50 cents, I'm going to get out? Or 50 cents is relative. Or do I want to do a percentage off the high, which a lot of software will do? So let's say the stock went up to $50 and you say, okay, when it pulls back 1%, that's when I want to get out of the trade. So 3 really clean decisions on when to pull the plug on that trade. Now, percentage is probably the easiest one, and probably the, I'm going to say best in very light terms here, because percentage is related to the stock price. How much it moves, like 50 cents or $1, is a random number you're actually picking. It might be off the chart or whatnot, but the percentage, it could be a $100 stock, a $500 stock, or a $50 stock. It's still 1%, whatever that normal move is. So you need to decide. And first you need to let go of the idea that you're going to get the top of the bottom. That's garbage. Nobody will ever do that. It's never been done in the history of trading, ever. Okay, maybe you'll top ticket once, maybe you'll bottom ticket once, but don't try and do that. You're not trying to do what you're going to do once out of the history of trading. You want to do something that it's repeatable. Profitable trade, what's my average true range? Profitable trade, what's my average true range? Is a day trade. As that stock gets up there and hits, now you want to, the whole point of a trailing stop is you get to the average true range. What if it keeps going? What if it hits the average true range? Like we saw in Penn the other day, the other chart that I showed you, it went $7 when the average true range is 5. You're like, oh my gosh, you made me get out $3 early. Well, no, we're telling you what to do now. If it gets up there and it doesn't pull back and moves higher, you move your trailing stop higher. If it moves higher, you keep moving your trailing stop higher. The one other way to do that is with moving average crossovers. We usually use the 10 and the 20, so that when price crosses over the 20, that's one exit, and when moving average crosses over the other, that's a second exit. But here's the thing. If you're looking to squeeze more out of your trades, you have to be okay with some drawdowns in exchange for those bigger moves. So there really isn't a perfect exit strategy that everybody can use at the same time. I'll give you, for example, I might be up $2,000 on a trade and I'd be like, you know what, that's pretty cool. I'm going to take it. And I don't care what happens after that, because I just want to see my account grow every month. Now, after the fact, I might go back and say, were there other circumstances that I could have added to the equation? And let's use yesterday as an example, where there were definitely some stocks that were strong, but the market was getting beat up pretty hard and actually closed at or near the lows yesterday. So what can you expect to get out of the trade when the market's getting hammered? Well, if the market's getting hammered, but that stock is strong, the next thing you need to do is look at the sector. Are a lot of stocks in that sector strong, or is it just one stock? So then you're kind of like trading that lone stock and managing everything on its own. But then you want to add the pieces. Is it just that stock, or 5 other major stocks in that sector also strong? When you got a little more buying power going into that sector, a lot of money doing the same thing in that industry. So despite the fact that the market's going down, that sector could be strong. And we see this quite often where we've been commenting sector rotation so fast as from one day to the next. You could hold those trades a little bit longer despite the market going down if that sector or industry is getting a lot of buying pressure today. So these are the kind of decisions that you need to make. And I'm not going to say on the fly. This is professional decision making. You need to be in there and making. You can't trade in a vacuum. It's like, again, I keep using driving. It's not, driving isn't like I was on the road yesterday, I did 75, and I'm just going to keep doing 75. You can't do that. You have to act like a pro, which is what we talk about in the community. Act like a pro, trade like a pro. The more you notice, the more you'll make. The more you'll notice, the more you'll make. And the more you notice, the more you'll avoid. Just as important. Now, swing trading is a little bit different. Swing trading is not watching the average true range. You're not watching what's going on just on that intraday price action, which a lot of people have that problem with, where they're day trading their swing trades, which can drive you crazy. You can absolutely use day trading entries to enter swing trades, but you should have your stop losses on the higher time frames, either the hourly or the daily, because you don't want one little blip as a day trader taking you out of a position that moves $30. That's just silly. So how do you manage your profits on your swing trades? Well, first I have this mental model, which is normally 4 to 6 candlesticks, like somewhere in that momentum move, where if we have the well-bid candlesticks, which is higher highs, higher lows, higher highs, higher lows, and more importantly, closing on the highs, that's my profit target. So I'm usually looking for that 6 candlestick momentum move. Starts at 4, and then I look to see how it reacts. Or you can just look to the left and say, what does this stock normally do when it has a bullish run? You just kind of find a spot where it stopped, where it started, and then be like, okay, that time it went $10. The last time it had a bullish move, it went $12. Last time after that, it went $13. It's like, okay, give or take somewhere between $10 and $13. That's my profit target. The beauty of this is, first, is its simplicity. But the second part, which to me is everything about trading, is it's easy. I'm not looking to like use all this fancy software and all that garbage. What does the stock normally do? That's why I love using average true range as a day trader for a target, and then looking to start setting my profit, my trailing stop, because that is what the stock normally does. We're not guessing, we're not forecasting, we're not predicting. That is what the stock does. Same thing with swing trades. As it starts to move up, you start to move up 3 candlesticks, 4 candlesticks, and then all of a sudden you start to be like, oh, okay, normally it moves $10. Normally it moves $12. So you have to have an idea. Okay, that's my target. So I need to see how the stock reacts between that third and fourth candle in my direction and the target. I'll give you an example. We actually had Starbucks about a week and a half ago. We had the entry was around 80 something and the target was 92. As it started getting up to 90, we started seeing a little bit different price action. So you have your target, but then you pay attention to your price action, and then you might move your stop up a little tighter on that as well. So we're trying to, I want in these videos and in these trainings to really get you to the point where you're starting to think a little bit more than just a chart reader. You're starting to think like a tape reader. You're starting to put the pieces together. And that's really where trading starts to get exciting, because now you're in control of how much money you make, not the market. It's not the market's going straight up. It's not the market's giving you a gift. You're looking at the market every day and you're saying, I know what I'm doing. It's just a question of follow through at this point. Have a great day.